Prime Minister specifically has done extremely well. Manish Sonthalia is joining us right now. He's Senior Vice President and Head of Equities, PMS at Motilal OSwal AMC. Thank you so much for joining us, Mr. Sonthalia. I wonder whether you managed to hear what Deepak Parekh was saying, and he believes that, and if you put it in the context of what he had said almost 1.5 years ago, he now believes that things have really changed on the ground. Are you also seeing that in terms of corporate earnings, in terms of the economy overall?
No, I think, foreigners are far more upbeat on what is being projected from a next 5-year point of view. So whether it be doubling of farm income, direct benefit transfer, these are things which have really gone down well with the foreigners. And that is why, when it is articulated and put in numbers, it means that the GDP of India should grow at a very fast rate between now and 2020. So that is basically the entire thesis on which this optimism is coming around. But at the ground level, even for this quarter, I don't think numbers are, even as per expectations so far.
Right.
So IT has clearly disappointed. Private sector banks is also a mixed bag, and so on and so forth.
Okay, I'm going to take this up one by one, but first of all, let me just go back to an interview that you did with us last month, and you said that you would buy whether, and I think it was right after the aftermath of Brexit, and you said whether there's Brexit or not, there will be some impact, but you would be a buyer if valuations exist. The market was looking slightly hot at that point, but at dips you would be a buyer. It's become even more expensive in a sense because corporate earnings have actually not met what the estimates were. So effectively, both in terms of the earnings estimates that should be pared down and the markets have gone up. Are you kind of changing your strategy?
No, not really. The direction of stock prices are a function of earnings, and they are also a function of the equity risk premium.
Right.
So equity risk premium all over the world is coming down. Cost of capital is coming down, and post Brexit, there is now more a case of monetary accommodation or loose monetary policy that is going to be followed by central banks all over the world. So even if you have the same earnings, it's getting discounted at a lower rate, which means that the P multiples
interrupt you there because I would like you to, we've got you, and I would like you to give a little bit of, investing 101 to our viewers. Equity risk premium, you mean that the premium you pay, you expect from equities over and above a safe instrument, right?
No, actually, stock prices are nothing but the present value of future cash flows.
Right.
So cash flows are a function of the profit and loss account or the profits a company is going to make.
Yeah.
You have to bring it to the present value. So
Right.
you got to discount it or,
Right.
have the present value discounted by a particular rate. That particular rate is actually coming down because the cost of capital worldwide is coming down. In developed markets, we are seeing the rates traversing towards zero and so on and so forth. So even in India, we'd see a case of rate transmission, which will mean that the cost of capital should come down. So P multiples for the same cash flows should be higher.
Okay.
And that is exactly what is happening. Even if the numbers are not coming for this quarter, it's all about, the future earnings growth for Q2, Q3, Q4, and then the cost of capital actually coming down.
So you're essentially saying because there's higher liquidity, cost of capital is coming down, it is fair for PE to expand?
Yeah, I mean, till we get a sense that now interest rates in the system or, global system are going to move up, and within that, rates are going to actually go up even in India, till that time, it's a case of equity risk premium actually coming down.
But you started off by saying that you were slightly disappointed with the Q1 earnings. Now, just break it up into sectors because the only thing that seemed to have outperformed, I know you can't talk stocks, but I'm just going to say it, is Reliance Industries Limited, right? Because other than that, you take that out, then the numbers look pretty bad.
So IT has been a clear disappointment, and there's hardly anything to find positive about the IT numbers whether we talk about the large cap IT names or whether we talk about the mid cap or the small cap IT names, it has been a clear disappointment. Of course, expectations were muted, but the commentary that has come, post the announcement of the results has been bad. So, private sector banks, if we come to, it's a mixed bag. Some have reported, those who are focusing more on the retail side of the lending have reported decent numbers, but those who are having legacy problems continue to have those legacy problems. And the PSU banks, by and large, have not yet reported numbers.
Even there in the private sector bank space, I know that you're very, very bullish on private sector banks. You've been saying that repeatedly. Even in the private sector bank space, the asset quality seemed to be more, I would say, more concerning than one would have imagined.
Yes, I mean, the pain has really not gone down if you were to look at from a quarter-on-quarter basis. So it's not going to go down for the next 1-2 years. We'll be lucky if the entire problems in the system are going to get corrected over the next 1-2 years. In fact, there is now apprehension that the SME space is actually going to see increased NPAs two quarters down the line. So from the third quarter onwards, you are going to see pain in the SME space.
And why is that?
But we got on private sector banks. Sorry?
Why are you saying that the SME space will see pain?
I mean, because of the sluggishness in the economy, till now they have held good in terms of loan repayments and interest repayments. But what the bankers are telling us is that because of the sluggishness getting extended, and they having inability to service the leverage which they have on their books. So that's going to show up in all likelihood within the next 2-3 quarters.
That's interesting,
so
because
that's the sense we are.
That's interesting, because what you're saying is that what in technical jargon I see in reports is called channel checks. Channel checks seems to suggest that on the ground there's a slight bit of pessimism, because if I look at what the PMI data that comes out, where we see an improvement, but on the ground, at least on the SFB side, there seems to be a pessimism. In fact, when we talk to managements on this channel, a lot of times we say that great numbers, and they sound a little wary and say, yeah, the numbers are great, but we'll have to wait and see. So corporates seem to be much more cautious than the markets themselves.
Well, that is always the case, markets gauge things into the future, and corporates are more on the job, and they see things happening for the good, and then they want to comment that things are improving for the better. But suffice it to say that if the monsoons are decent, etc., Q2 onwards, we should be seeing decent numbers as we compare it with the current quarter numbers. And the current quarter numbers have not yet fully come out, but in the second week or first week of August, and by and large, the decent names would have already come out, and that has been the history. So let's hope for the best, but numbers so far has not been all that good.
Does that change the kind of earnings estimates that you're making for the indices like Nifty and Sensex?
No, I think the silver lining is that the rains have been good. The monsoons have been decent so far, and IMD projections seem to suggest that August and September we'd get a surplus rainfall. If that was to happen, then obviously earnings trajectory will move on the positive side from Q2 onwards. Markets are building quite a bit of all that, and so now some amount of GST hope is also coming back to the market. It's very difficult to believe that the markets are going to see some serious correction. 2, 3, 4, 5% correction can always be there, but and that will also happen on the back of macro disturbances, not anything India specific.
More liquidity driven.
Very difficult to believe that we'll see major correction from these levels. I think markets are headed even higher from these levels.
If I look at the the Fed's commentary, and last month when the FOMC met, and the minutes, there's one gentleman, George L. Esther, I think, Esther L. George, who generally votes against the consensus and asks for interest rates to be hiked. 2 consecutive FOMC minutes actually see him saying that no, he went with the consensus, and he's back to being hawkish. There's another member who yesterday gave a speech where he said that the markets are underestimating the Fed's commitment to tightening. Now, there is liquidity, there's no doubt. And today we've seen that that comment actually led to a little bit of strengthening of bond yields. But this is the kind of, this capital is pretty fickle, right? You see a sudden movement in terms of interest rates, and almost within 2 days you see funds flowing out.
Yeah, the situation is that if the interest rates were to move higher, then we'll have a whole lot of asset class readjustment in terms of the asset prices. But the tricky point is that we are not seeing any circumstances whereby there's going to be any near-term increase in rates.
Yeah.
We can't be talking about next year. Nobody knows what is going to happen next year.
Right.
Even the central bankers themselves are not very clear how the FY17 is going to play out. But till about December, we should be in for a status quo stance as far as the rates in the US are concerned. I mean, that's the assumption we are building in.
But
if there's anything to the contrary, obviously stock prices are going to react adversely.
Yeah. But the old classical fundamental, the theories of fundamental, where you look at investment and the old thing that don't look at the price, or Mr. Market that Warren Buffett calls, look at the intrinsic value, and even in terms of relative value, look at cheaper stock. It's almost impossible to find them right now. It's virtually impossible to find them if you actually work out some. I know you said that the cost of capital has come down, but if you actually look at the long-term cost of capital, you'll have to look at what is going to happen over a period of time. How are you finding value? Where are you finding value? What are you doing in terms of your analysis to look for companies?
So you got to lengthen your investment horizon. It's not about 1 day, 1 month, 1 week, 1 year. We are talking about 2-3 years and above. So lengthening of the investment horizon first has to be kept into perspective, and then we got to visualize how earnings of particular companies are going to shape up within the broad macro environment that we are all operating in. So if GST was to come, what sort of an impact would have on the cash flows of these companies on a status quo basis, because difference in rates, 28% for certain sectors coming down to 18%, obviously means 10% savings on taxes. Yeah. Whether all of that benefit is going to get passed on to consumers, answer is a clear no. Some of that is going to be retained by way of profits by these companies, which means increased cash flows, and then on top of that, organic growth due to the natural growth in the economy. Right. All of that means augmented cash flows than what the situation was before. Then you discount that to the present value. So in essence, it is finding terminal value. How accurately one can find terminal value, there is a whole lot of scope even today. So GST will open a whole plethora of opportunities within the consumer space, both discretionary and durables, autos. Private sector banks obviously are seeing value migration from the public sector banks, taking market share away from them. NBFCs, because they cater to the SME space, and public sector banks will find it difficult to incrementally lend at the same pace at which they have done in the last 3-4 years. Right. I mean, these are some of the names. Defense would be one area which could throw up some interesting opportunities, provided government opens up the sector in terms of order inflows and JVs and FDIs, and business starts flowing in. All of that is happening, but at a muted pace. So if that picks up, again the cash flows of companies are going to shape up positively. So the broad view is that the outlook remains quite optimistic. Of course, it boils down to picking up individual stocks rather than sectors. Right.
Unfortunately, you can't give them to us because of compliance. I understand, but you were saying that if the revenue neutral rate is going to go down from 28% that people pay to 18%, that, as you said, that's a huge saving, a 10% saving in terms of taxes, and let's say 5% they give and 5% they keep. For the government, at an overall macro level, the taxes have to be kept the same, right? So the only way you can do that is either increasing taxes on the things that you've kept out, which is fuel and liquor, which will difficult to make up for all the losses that you make on this, or else you actually increase income tax or corporate tax. Now, the net impact is effectively the same, right?
No, so if you lower the taxes, then there would be greater compliance. which means that the total pie of what indirect taxes the government is making today is actually not going to go down. Anecdotally, all over the world, whenever rates have come down on the indirect tax front, your pie has actually grown rather than create any shortfall. So, that is how this revenue neutral rate has come into picture. Why not a 20%, why a 18%, and why not 16%? You have at a situation where there is going to be greater compliance, so the entire pie of the taxes are not going to go down. Within that, who is going to share what and who is going to save and earn more is something which one needs to figure out.
This would also involve some of those companies which actually operate on a slightly lower tax moving up the scale in terms of tax payout. So you have to actually work them out individually. Work them out individually. I just want to, look at something like pharma, right? About 1 month ago or slightly before that, there was a lot of bad news in that space. There were these, and always that overhang of a US FDA person coming into your factory with a form that you have to fill. That seems to have gone out for most of them. Valuations haven't caught up at that pace, maybe for whatever reason. Is that something that you think is has some value, something that still people can buy?
Of course, there is far more value in the mid-cap pharma space than large-cap. Obviously, growth rates, because of the base of large-cap pharma companies, the growth rate is going to come down from, let's say, 30% to something like 15% or thereabouts. PE multiples on a 1 year forward basis are still about at 22 times, which means we are buying at more than 1 time price earnings growth. But in the case of mid-cap pharma companies, when the entire world is moving towards specialty, complex, generics, injectables, these guys would be doing the normal, generic manufacturing, oral solid dosage. So, and they are going to get incremental business. So, because of a low base and incremental business being good, P multiples being what they are, around 18, 20 times, there's far more scope in the pharma names in the mid-cap space than the large-cap space. But on an overall basis, I genuinely believe that the pharma space has bottomed out in terms of the stock price depreciation that we have seen over the last 1 year or so.
All right, Mr. Sonthalia, my colleague Pankaj Poddar has a few questions for you.
Right, Manish, you've always liked aviation as a pack. Now we saw Interglobe Aviation results yesterday. Of course, you cannot comment on the company, but 8% drop in average ticketing pricing. Is it telling you that industry is now passing on the benefits? They are wanting to lower margins for better market share, and that's a concern?
No, I think it's a problem of excess capacity creation ahead of what the demand situation is. So, most of the airlines today are not having any major capacity addition, barring a few planes here and there. And if passenger traffic growth is 20%, you got to increase capacity by 20%. It's as simple as that, because otherwise the prices are going to shoot through the roof. So the average drop in yields of 10-11% for the first quarter, I don't think is going to sustain for the rest of the year. If you hear the commentary, etc., it doesn't look like that we are going to see ticket prices fall from 4,400 rupees on an average to 4,032 rupees. Of course, the competitive intensity is high because one of the airlines actually front-loaded the increase in capacity, thereby dampening the load factor. But if they are going to delay the taking of capacity, which is delaying the taking of A320 Neos as delivery, then obviously capacity is far more balanced and competitive intensity should ease out over the next 2-3 quarters. On the other hand, valuations are extremely comfortable.
Right. You would still be bullish on large cap aviation. That's a space that you would still like. You believe that things 100%. Have changed. I mean, 5 years, 100%. And what are the triggers? Again, 100%. The passenger growth traffic of 20% plus.
Correct. And, we have seen oil prices move up to 50. They are now touching closer to 40. Who knows whether they are not going to touch 30? I don't have a clue. But if they remain within the range of 30 to 60, we are not going to disturb the 20% passenger traffic growth.
All right,
And, you
I
know,
just
if-
I just want to come in there. So clearly, Mr. Sonthalia, you're on this one, you're completely against Warren Buffett, right? Because I remember watching Warren Buffett in a video where he said that every time he wants to invest in an aviation company, he calls up Aviation Investors Anonymous and they dissuade him from doing that. So clearly, you
But
think,
you know, Southwest Airlines
yeah,
has created more wealth than Berkshire Hathaway between
Great.
point A and point B.
that's a great answer. Pankaj, go ahead.
Right. Manish, you were also quite bullish on housing building material. So, not particularly on the large cap infrastructure space, but probably, things that support that. What are the sort of sectors within that sector that we are looking at, or, what sort of companies are we looking at that in that sector?
The entire space where the movement is going to be from the unorganized space to the organized space. So whether it be plyboards or tiles or faucets or bathroom fittings, paints, all of them are going to see incremental benefit. Then it will boil
Right.
down to picking up the individual companies based on management, dividends paid out, quality of growth, and so on and so forth.
Right. A lot of these companies are also unlisted right now. So you expect a lot of IPOs to come in, which itself can, rerate the sector.
I mean, IPOs are in a frenzy. This is one aspect which I fail to understand. Mid-cap IPOs getting 100, 200 times subscribed, it just doesn't, I mean, if there are any of these companies who want to come out with an IPO, there could not be a better time because the market itself is overvaluing the IPOs, and on top of that, you have a structural shift from the unorganized to the organized. There could not be a better time. Of course, there are going to be many more IPOs in this space.
No, what I was asking was IPOs about building material. A lot of sectors within sectors, smaller companies in infra are coming up with IPOs. That will re-rate the sector, something that we've seen with Interglobe earlier, maybe some other sectors like, ancillary towards pharma like a Dr. Lal. So can that happen in this sector as well?
If you have more players coming in the organized space, obviously, value unlocking will happen, and peer analysis would be much better. So, of course, and it's an opportunity for more players to compete. There is far more room for many more players to come in each of these individual spaces, whether plyboards or tiles, etc. So, yes, it is a logical conclusion that that's going to happen, and you'll get many more names which will open up the sectors much more.
Right. Just a last word as far as the flow picture is concerned. You think the flows are coming in very strong, and that is leading to a compulsion for a lot of fund managers to come out and buy or, match up the stake with what they have, and that is taking the mid-cap valuations high, which is a risk in the near term?
No. Retail public is very, very skeptical. Post-Brexit, the entire market was net short. We saw that short unwind, in the run-up to the previous expiry. And so, to believe that flows are driving the markets, answer is no. It are the foreigners who are driving the markets. They are the ones who are buying because their cost of capital, the equity risk premium in their markets have come down significantly. And emerging markets offer a much more sanguine and a predictable growth as opposed to developed markets over the medium term.
Right. Manish, thank you so much for joining us this morning, and I hope to see you again soon. As far as markets are concerned, we did go up about 30, 40 odd points, but then, we are seeing slight bit of normalization from that level, about 20 points higher now for the market, 8,656. Taking a break, coming back in 2 minutes, lots more lined up on that.